Welcome back. Now, in what came as a shock to many, the UK has chosen to leave the European Union. This decision, of course, has its economic implications for both sides. I'm being joined now by the head of group research at Interbank London, Edward George, to look at some of these issues. Good afternoon, Edward.
Good afternoon.
Thank you for joining us. Are you as shocked as I am? Are you one of those that voted to leave the EU?
Well, the vote was secret, so I'm not going to say that. But I would say, certainly here in London, everyone is very shocked. I thought the vote would be very close. I was obviously hoping that it was going to go for the Remain camp, but it didn't. But what doesn't surprise me is the split in the country, because this really has split Britain right down the middle. London, the large cities like Liverpool, and also Scotland, Northern Ireland were very strongly for Remain. But what we would call Middle England, everywhere outside the major cities, was very strongly for Brexit. And in the end, that swung it. But the reality is that the difference in the vote is around 1.3 million votes. That's not a statistical error. That's a very big amount. And what's clear is a lot of people in Britain were very unhappy with being part of the EU. But we now have a genuinely divided country and a huge amount of uncertainty about what the next step is.
Now, we have seen the pounds plummet, stocks have tumbled. What implication does UK's exit from the EU have for businesses both in the UK and the EU?
Well, the implications are just so huge because Britain is very heavily integrated into the global market. We're not just part of the European Union. Part of the reason there's been tensions with the EU is that London is an international financial centre. We have very strong commercial relations with many parts of the world. We're the second largest recipient of foreign direct investment. We trade something like 80% of all of the euros in the world are traded in London. 80% of all the contracts in the world for trade are English law. 80% of all debt in the world is linked to LIBOR, which is fixed here in London. So it's not just about the implications for the EU or for the UK, it's for the world economy. So I think if the Brexiters were trying to prove that Britain is still great, they have. Unfortunately, we've done it in a very negative way by hugely disrupting global markets. But I mean, we've already seen the pound has regained some ground in the last few hours. Everyone is expecting to see, give time for the dust to settle, and then we're really going to have to work out what comes next.
Right. Now, let's tilt towards the frontier markets like Nigeria, Ivory Coast. What are the expected impact on these markets?
Well, I think in the short term, they're just going to suffer from the same kind of market turbulence the rest of the world is, as a lot of investors are moving to safety. They don't see the pound as safe anymore. Lots of movements in different currencies. We've seen it in Japan as well. And it's likely we could see the euro and dollar going back to parity. So obviously that would have an impact on the CFA franc zone, countries like Cote d'Ivoire, Senegal, whose currency is pegged to the euro. But I think in the case for Nigeria or Kenya, South Africa, we're really going to have to wait and see. The issue here is really going to be about how the investment picture is affected in the UK. But certainly you would expect in the medium to long term that if the Brexiters really are true to their word, they're going to want to reach out to other countries and do more trade. So that could mean actually much better trade relations with these African countries. But I think in the short term, they're going to suffer from the same instability that is affecting all markets at the moment as everyone digests this news.
Right. Now, let's look at the interbank relationships. What are the possible implications?
Well, I think as we've seen going on in Africa really for the last 3 or 4 years, because there has been such a ratcheting up of compliance and supervision by regulators, a lot of correspondent banking relationships have been forced to be curtailed. We've seen many international banks cutting off their relations with African banks simply because they feel they can't meet the conditions of know your client or anti-money laundering. And so this will definitely feed into that debate. Ultimately, I think it's both positive and negative, and it may be in the long run, interbanking relationships on the one hand will suffer because the EU is losing Britain, but then will gain because Britain will want to make separate correspondent banking relationships. I just think from a regulatory point of view, it's a nightmare. And the only people who are going to be happy this morning are lawyers, because they are going to be very busy for the next 4 to 5 years.
Oh. Now, let's look at the issue of trade relations. You did mention that. Now, where does that leave some of these areas, of course, the frontier markets, the UK, the EU, in terms of movement?
Well, I think we're going to see initially anyway, everything continue as normal. I mean, nothing changed this morning. There has been a vote which says that Britain wants to leave the European Union. They haven't triggered Article 50 yet, and once that is triggered, there's still at least 2 years of negotiations. So In the meantime, everything remains exactly as it was before. The problem is to do with investment. If investors who might have invested in the United Kingdom might have wanted to have operations which involve bringing in commodities from Africa, they're not going to want to. So in other words, we're going to feel the effect in the next 6 months. But at the same time, I mean, Britain has very strong trade relationships with Africa, particularly with English-speaking countries. If anything, we're going to see them strengthened.
Now, do you think the UK economy is strong enough to be on its own?
Absolutely, but I mean, I go back to my original point. The UK economy is not on its own. I mean, we're part of the global economy. London is one of the international hubs of the world. We are intricately related to all of the other economies, all of the other economic decisions made elsewhere. We do 40% of our exports to Europe. And the fact is, if you look at Germany, a fifth of the cars they export are to the UK. No one is going to go looking for a trade war with the European Union. So the thing is, of course, Britain can survive on its own. It's just that many of us in this country don't think that was the right way to go. But we're not going to be on our own. We need to have now a new partnership with the EU. Who knows how that will be? And maybe we can rejig our relations with the rest of the world. It's just another step in Britain's constitutional history. I mean, if you look at some of the experience we had beforehand, we ended up with a Dutch king and then a German king. So anything's possible.
Now, you did mention that the pounds have started, regaining. Are we likely going to see the pound sterling coming stronger in future?
Yeah, but perhaps in the distant future. I mean, I think what's very good is the governor of the Bank of England, Mark Carney, this morning came out and gave a very clear statement that, listen, they will support the pound and they have the firepower. Even though bank stocks have taken a clobbering, banks are in a much stronger position now to deal with a crisis. Of course, no one expected this crisis. And so ultimately, listen, the pound is likely to lose more ground. It may be that we see over the next few weeks, it really does weaken significantly. But I think we will see a stabilization will come eventually. And really, once people become clear about what it really means, this Brexit vote, if it really is going to change the economic outlook, I think we'll see the pound strengthening again. Because the UK has always been a relatively stable economy, and many of the things that investors like in the UK, the rule of English law, the very strong precedents and the openness of the UK economy, they shouldn't change. So it really is just a question of whether international investors believe that by leaving the EU, we're going to shoot ourselves in the foot economically and we're a bad bet. If we can prove that we are still very strong on our own, then I think actually we'll see the investment scenario continuing as before.
Right. So going forward, what next? Do you foresee yet another referendum for UK to come back?
Oh, I think at least one. At least one referendum. And let me tell you, it's not just the UK. I mean, first in the UK, whatever deal is eventually agreed, there will then have to be a referendum to say this is the deal that we've agreed. Scotland is definitely going to go for a referendum for independence. And in all honesty, if you look at the current polls, it looks like they would go for it. You have to wonder about how London and how Northern Ireland are going to accept this kind of position as well. But of course, you've got to look at Europe. I mean, they're already talking about Frexit, a French referendum next year. The Danish, the Dutch have always been very, very anti-European on many different issues as well. Who says the Italians, the Greeks, and the Spanish are any happier? So there is a real danger we could see a dozen referendums over the next 2 to 3 years and a huge amount of instability as a result of this.
All right, thank you very much for your time, Edward.
My pleasure.
That was Edward Judge, the head of group research at Interbank London. In South Africa, the rand slumped more than 8% against the dollar on Friday, on track to its biggest one-day percentage fall since 2008, as Britain voted to leave the European Union, knocking appetite for riskier assets. In early trade, the rand traded at 15.34 versus the dollar, 6.53% weaker from its New York close on Thursday, as its weakest level in 3 weeks. Government bonds also weakened, with a yield for the benchmark instrument due in 2026 adding 24 basis points to 9.12% after jumping as much as 28.5 basis points earlier. Now we'll take a quick break. Now when we return, we'll look at the debt market. Do stay with us.